Hey everyone, welcome back to your weekly market outlook, and this is for the 22nd of September 2025. A lot to kind of uncover from last week's FOMC interest rate decision, and we did post a couple of articles about this, about the potential of what the FOMC is likely going to be doing, and it is more of a hawkish cut, and that's basically what we got. So initial market reaction to this was obviously for a drop in the US dollar, but then everyone kind of just reassessed what the FOMC actually meant, and everyone realizes, oh yeah, you know what, there's actually not much that the FOMC can do in terms of aggressively cutting interest rate, just as what we kind of anticipated before. So basically what the statement was from JP, it's basically that this is more of a risk management cut, rather than, you know, more of them being late to the party, them admitting that it's a mistake. They're basically just doing this because, hey, you know what, there's a little bit of a weaker positioning on the labor market in the US, and we're just cutting it just in case, right? But in terms of how sticky the inflation is, I think sticky inflation is still going to be an issue for America at this point in time because of all the tariff decisions made by Trump. And with the economic projections, we did note it that in terms of the potential for 2 more cuts this year is still there. So we're expecting another 25 basis points cut next month and November, and a potential for 1 more cut in the first quarter of 2026. But end of the day, what market has been pricing in towards end of 2026 was really 2.75 to 3%, 3.25% in terms of interest rates. But the economic projections that was published last week by the FOMC, they're basically looking at 3.4% next year, by the end of next year. So it is a little bit harder than what the market has been trying to price in so far. And that's basically what's been going on there. So yeah, that aside, if we take a look at what we're anticipating this week, there's actually not a lot. We're going to be looking at manufacturing numbers, but at this point in time, those manufacturing numbers are pretty much irrelevant. We've got the Australian inflation numbers. We're expecting inflation to tick up a little bit higher from 2.8 to 2.9%, but probably not exceeding 3% at this point in time. We've got the Swiss National Bank interest rate decision, that's going to be at 0%, no change on that one there. In terms of the final GDP in the US, that's to be at 3.3%. We've already got 2 earlier readings on the quarterly GDP numbers from the US, and you know, everything is pretty much at around 3.3% from the preliminary numbers. So this shouldn't be a market moving event at this point in time. Right, and then we have the PCE numbers at the end of the week from the US, and this is unlikely to change what the FOMC has basically came out with, that they're going to be cutting 2 more times in 2025. So at this point in time, the PCE numbers are irrelevant. We're probably going to be looking at that as a potential measure on how sticky that inflation is going to be, and we might actually see more of a reduction in terms of, you know, traders pricing in for a lower rate in the future. Right, let's take a look at the technicals here on the Aussie USD, and we are pretty much on track that we were looking at a higher range, 65 to 67. Last week's price got rejected at 67, and you know, price is currently hovering around just below 66 level. We still have 65 cents as a much stronger support. The only concern that we have here, even though the 65 cents level it's pretty much overlapping with the Ichimoku cloud as well as the support 200 weekly pivot, it is a very thin Ichimoku cloud. So there's actually a very thin balance here. If we lose 65 cents on Aussie here, it could actually slip all the way back down to 64, and you know, that would change a lot of the scenarios that we have right now for the Aussie USD, that this is stable. It is stable, but the range could get wider. So far in the past few months, it has been stable in the range of about 2 cents. If this drops to 64 cents, that would actually take the range to a wider range, about 3 cents on the Aussie USD. Right, Euro USD is up next, and with the Euro USD, we're looking at price, did pushing higher here. It did overcome the previous high in the month of June. There, it posted, yearly high at 1.19. It did, but if we take a look at that level, there it was actually a very strong selling at 1.19. So either profit taking happened or there's a position adjustment that's been happening here on the Euro USD. Currently, it is still above 1.17. But if it does close below 1.17 on Monday, it will likely track a little bit lower for a deeper correction towards 1.16. We're probably not going to be looking at a much more significant support other than that level this week. They're around the support 1 and support 2 on the weekly pivot as well. So that would be between 1.16 to 1.1650 on the Euro stochastics. On our side, still indicates that this has further room to go in terms of correction. The sterling, likewise, it's still in that pullback right now. We're currently looking at a very strong support building at 1.34. Also where the Ishimoku cloud is currently located. In terms of key resistance, it's now back to 1.36. So we're anticipating a 2-cent range on the sterling here between 1.34 to 1.36 for this week. But yeah, this would still fall under a correctional phase and not a transition in trend. All right, finally, we have the dollar yen, and for the dollar yen, this one here very tricky. Price does bounces off the Ishimoku cloud again, and price did break below the support trend line, but immediately recovered the next day. It didn't close the week below the support trend line right now. So, if we look at the price movement last week, this would basically states that the support trend line is still strong at this point in time, but we do have order blocks coming up now very soon, 149, and if we do break above 149, we are going to meet a much stronger resistance at 151, which is going to be the key levels to watch out for on the dollar yen. On the flip side, from price movement last week, what we need to see is a confirmed close below 146. We did breach below 146 to 145 range, but price didn't quite close the day below 146. So from that, we are going to be looking at the potential close. Any potential close below 146 would lead price lower towards 144, potentially 142, but probably not as extreme as the probability that we have last week or the week before that. So far, this has been pretty resilient, and if we take a look at why this is happening, again, it's not really monetary policy. Obviously, monetary policy divergence does contribute to this as well. It's not really putting a lot of carry traders into the buy dollar, sell yen scenario here, but really it's more of a fiscal situation between the US and the Japan right now. But that's basically the driving force. Either of these are not the safe haven assets that the market is looking out for. Safe haven assets right now would fall solely on gold because of all the geopolitical tensions that's kind of heating up at this point in time. All right, so with that, good luck to trades, and I'll see you soon.